Hopefully you enjoyed part one of. So let's discuss guaranteed lifetime income benefit riders. Everybody wants to know, why would I want to add these to any given contract, particularly when I already have an annuity? Well, there is a very defined difference between having just a regular annuity and one that is a fixed indexed annuity that has this rider. First and foremost, traditional annuities typically require annuitization to guarantee a lifetime income stream. Now, what is annuitization? It basically requires you to give up access to your lump sum. You essentially give that lump sum of your annuity to an insurance company, and they in turn guarantee to give you a lifetime income stream forever. It's nice because you can rely on that money forever, but forever again, you will never be able to gain access to that lump sum for any emergencies that may come in the future. The Glibbers are much more flexible, and they have what's called a guaranteed roll-up rate of return within your income account once the rider is added to your fixed indexed annuity. I don't want to spend too much time explaining that here, because in a couple of slides you're going to be able to see an actual explanation, functionality, how the thing works, all the ins and outs. So just delay your curiosity for just a couple of slides more and I'll explain exactly what that means. Last, you maintain control of your income stream even after your income is triggered in the rider. What that means is you can actually turn that income on and off, which can be very helpful in certain tax situations. If you don't need it to turn off, well, then you can just ride it straight through, and then later, again, more slides into this thing, you're going to be able to see how letting that ride will actually help you in an inflation-oriented situation. Now, just before we move on, I wanted to remind you of this slide from the previous Part 1 presentation, and it has to do with keeping an eye on what actually happens to your balance in a traditional withdrawal, not annuitization, not annuity, not fixed index annuity, just a plain old straight up withdrawal feature if you were to just have a private account that you're drawing off of. Alright, having said that, let's move on with how we're going to explain these Glibbers, as I like to call them, the guaranteed lifetime income benefit riders. So the following two slides illustrate, again, general functionality of how these riders work. The calculations are shown without any caps or spreads or participation ratios, fees, any of that stuff, because what I'm trying to do is just show the basic functionality, and as you get down to the details of each individual carrier's offerings, then those things could be calculated in. But for right now, you just need to see how these things function. So, first things first. The following illustration is going to assume an income account value that has a guaranteed annual roll-up rate of 7%. This rate's been chosen because it's close to many of the actual rates out there right now. I'm going to call your income account value your phantom money, and your index account, the fixed index account, your real money. Just makes it easier and a little more illustrative. As with the previous illustration, we're going to use a starting value of $100,000. I like to keep it all uniform throughout. So let's see how it works. We're going to start with that $100,000, like I say. What happens then is the carrier will set up a separate income account that matches your real money that you just dropped into the account. So now it starts with $100,000. Because it is the Glibber, the Guaranteed Lifetime Income Benefit Rider, and we did say we're going to give it that 7% guaranteed annual rate of return called a roll-up rate, let's look at it as over a 10-year period to see what would happen. At this point, it's basic math, and you're going to end up with $170,000 at the end of 10 years at a minimum. Now, what's the advantage of that? The advantage is that when you're doing your retirement planning and you're trying to project out into the future what it is you're going to have to be able to rely upon when it comes to income, you need to have at least a floor that you can build out on and say, all right, if all goes crazy in the world and nothing can come true, at least I know this is going to be here because it's guaranteed in writing. So even if the market were to crash over the following 10 years, that's the very minimum you would have available. Now, keep in mind, you have your real money working for you, much the way we showed in the previous slides about how you gain through the index values. So 10 years of index values, less fees, caps, etc. would apply. Now let's assume in that same 10-year period, your real money only accumulated up to $150,000, which is less than the phantom. Well, we would, of course, when it comes time to pick up your calculations to make your lifetime income stream possible, we would like to calculate off the higher of the two. So we're going to go to the $170,000 of phantom money and calculate your income off of that. However, let's assume that your real money did really well. Let's say it moved up to $250,000. You don't have to take the phantom money. Again, we're going to take the higher of the two, and we're going to calculate your income off the $250,000. It is there to give you the floor. It is certainly not the ceiling. We're hoping the ceiling is much higher, but we want you to be able to calculate at least some measure of growth for the future so that when you look to plan, you're planning on a solid foundation, not on some shifting sands. Now, there's a few things I'd like to say about maximizing your annuity income payments. Right. First of all, you want to start your contract early and defer for as long as possible. If you do that, what you're doing is you're giving that phantom money, that roll-up rate, the chance to actually work on your behalf. You're also giving the index values a chance to work. So you're building within your contract in a safe area where your money can never be lost and your gains can never be lost. But you're doing it in a way that allows for the compounding, particularly the tax-deferred compounding, to work in your favor. Now, you want to use the income rider to trigger and control your income. These types of products work best if you add the GLIBR, the Guaranteed Lifetime Income Benefit Rider. That way you can control your income and trigger it when it is most advantageous for you to do so, and know that you're not going to have to give up your lump sum access in doing so. You want to look for contracts that reward your patients with higher income payout calculations. Now, income payout calculations are extremely important when you're looking at how much you're going to get on a per year basis from your income stream. Some contracts do tremendous things to compound, much the way all these other things compound your gains. They'll compound the actual income rate that they're going to be giving you. Whereas you might have said, okay, well, I'm at 65 and I'm going to get 5.5% out of my income account for the rest of my life. Some, if you had done the proper deferring and gone into the contract that's correct for you, you may end up pulling 8.5%, 9%, 10% a year out and having that become your starting point on your income. You want to take advantage of inflation protection features to maintain that purchasing power of your income. Remember, I said your starting income. You will have options in certain contracts to say, okay, yeah, give me this amount and that's it. I'll keep that even for the rest of my life. Or you have another option, which is going to, in most cases, work out far better, to protect your income from inflation by having an increasing value attached to the withdrawal amounts so that you can keep pace with inflation even after you've triggered that income stream. Very, very different from what you may have been used to up to now. So let's see how you can use the index for inflation-protected income. Some products do allow for the index to actually adjust your income even after you've started that income stream. So for this illustration, we'll say that the yellow is going to show the inflation rate, the red is going to show the index rate, and the green is going to show your actual income. So let's start out with saying that you started a year and your income has started out at $20,000 a year out of your annuity. All right, but you did elect to have an inflation-protected income out of the index. Well, at the conclusion of year one, we would say, okay, well, let's look at seeing the inflation rate's gone up. Well, the index has gone up a little bit too. Well, guess what? So too is your income because it was a 5% gain overall in the index. Now you've given yourself a pay raise to $21,000. Year two comes along, and it looks like there's going to be an increase there too, with the inflation going up, the index going up, and again, your income, of course, because of the way we're inflation protecting it, will go up. That was a 4.9% gain. You now have an income of $22,000, another pay raise. Now, year three, well, the inflation rate went down a little bit, and so too did the index. So in all these calculations we've shown you, when the index goes down, what happens to your money? That's right, nothing. It stays even. There's no gain, so you maintain, at $22,000. You don't take the down. Again, it's a repeating feature here in this, but it is something that bears reiterating over and over again. When it goes down, you stay even and you don't lose what you had before. Here comes year 4 now. Year 4 was a big year, a big bounce back year. Those big recovery years that people like to talk about. Let's say we went to a 9.2% gain. Well, guess what? Your income just went up to $24,000. Year 5, looks like we had another down year for the inflation, another down year for the index, but another even year for you, no gain. You maintain at $24,000. So you can see how inflation protecting your income, even using these index values, can become a very powerful tool to make sure that you are keeping pace with the purchasing power that you originally started with. Now, additional features of the fixed indexed annuities are: many will offer upfront or multi-year bonuses of up to 6% on your account, meaning new money. So that means that you put in $100,000, if there's a 6% bonus, you immediately have $106,000 going to work for you. Some offer interest rate bonuses. These are a little more complicated, but they're no less powerful, in some instances more powerful. Say, for instance, you were to get a 50% interest rate bonus on a particular product. That would mean if the interest rates went up to 4%, you would get 6%. If they went up to 8%, you would get 12%. So these interest rate bonuses in certain products can be very, very powerful in producing some pretty aggressive returns. Now, you can start one of these things using non-qualified money or IRAs, 401ks, Roth IRAs, or any other qualified type of funds. It doesn't matter the source or type or qualification of the money. It can be used to purchase a fixed indexed annuity. Rollovers are accepted, as are direct funds. So if you have money locked up in some old 401k, or you just have money sitting in a money market or even a bank and you want to move it, any type and variety can be done regardless of the institution that it's in. All fixed indexed annuities protect against the downside of market risk. That is a huge, huge thing. When you're doing the calculations and you're trying to figure out what you're going to do for the rest of your retirement years, you simply cannot afford to ride out market cycles when that income has now become your only source. Why do you need a fixed indexed annuity in your portfolio? Safety and flexibility. Strong written guarantees, not promises, folks. These are written guarantees. Smart money allocations. You can decide how to allocate across a variety of indices so that you can feel comfortable with how your money is going to grow in whatever buckets you chose to put them in. No market risk. I know, I keep singing that mantra, but there is no market risk. Great growth potential in a number of different areas, not only on your real money, not only in your phantom money, but on your income once you finally start taking it. All sorts of different features in order to make sure that the growth is there for you regardless of what stage you are in. And there is a lifetime of inflation-protected income you simply cannot outlive. If you live to 250 years old, that income will continue and will get to you every month, every quarter, every 6 months, every year, whatever mode you choose, to make sure that you can live in the way that has always been the way that you wanted to live. Again, my name is Greg Durrett. Company is Future Secured Financial, and we are the future of your protected retirement. Please contact me at the email or telephone number below, and hopefully we'll be able to put together something that makes a lot of sense for you, or at least be able to answer a lot more of the questions that I hope that we've started. Thank you for your time. Take care.